Today's podcast, I had Bridger Pennington on, and Bridger is the fund expert. This guy has trained students all over the country on how to start funds. We talked about all the differences of the various funds, whether it's private equity, hedge funds, real estate funds, 506B, 506C. If you've ever wondered what all these terms mean, we go in depth on it during this podcast. We also talk about some conspiracy theories of how Blackstone and BlackRock operate and why the Fed is actually buying equities like Google and houses. Why are they doing these things? We go into that. We also talk about where we think interest rates are going and inflation and many different other topics that you guys are going to be really interested in. And then we go into crypto and NFTs and what it's going to look like in the Metaverse as funds gain notoriety, people start raising money to do things. It is a really good podcast, one of my favorite we've done. So with all that being said, let's jump into it. Are you looking to grow your real estate investing business? My company, Future Flipper, can help. We've taught hundreds of people all over the country how to flip, wholesale, and buy rental properties. And it doesn't matter where you're at in your investing journey. Whether you're trying to get your first deal or scale your company, Future Flipper can help. We have courses, coaching, and events for all levels of investors. So if you want to take the next step, go to futureflipper.com and book a free consultation to see how we can best help you. Once again, that's futureflipper.com. If you've ever wanted to invest with me on my real estate deals, it's now possible. At Pineda Capital, we're purchasing value-add real estate all across the country. This includes multifamily, commercial, and land development. The best part is, with my network, social media presence, and marketing strategies, we're able to get the very best deals that others don't have access to. You can join in with me on those deals if you're an accredited investor. If you want to learn more, head over to pinedacapital.com to see our current opportunities. Once again, that's pinedacapital.com. Welcome to the Ryan Pineda Show, where our mission is to invest.
I only expect to make money in things that I understand.
Innovate.
It's about believing in the future and thinking that the future will be better than the past.
And inspire. I am much more likely to hit my goal just due to putting it out there.
You're now rocking with the best.
What's going on, everybody? Welcome to another episode of the Ryan Pineda Show. Today, I've got the fund master with me. He's a young, seasoned vet who's been in charge of different funds and has taught many students on how to start their own fund. It's really cool to have you in the show, man. What's up, Bridger?
Ryan, good to be here, bro.
Yeah,
it's fun
dude.
to see your office, the whole thing. I'm excited to be here. Yeah.
I know, man. If you guys don't know, Bridger is doing a lot of cool YouTube videos and reels and everything else. I like watching it, man. Like, you know, funds to me, I recently started a fund last year for the first time. Like, this is so boring. But then I'm like watching your content. I'm like, this guy makes funds interesting, man.
You have a 506C, right? That's what you said?
Yep.
And you're doing what? Obviously real estate out of it.
Yep. We bought 334 unit apartment building.
Yeah, really cool.
And then we're doing another one, 96 unit building right now.
That's kind of fun. Come on. That's fun. That's fun to take down a 300 unit apartment complex. Come on.
It's fun to do that, but learning about the fund and
get a
like
little boring.
how to do it, I'm like, just, I don't know. Hire somebody else. Like, I don't know.
Well, the mindless piece of it, actually, I literally was going through this. We're launching a new fund. And it's so, because a lot of people are like, oh, just hire a lawyer. They'll set it up for you.
Right.
And I'm with my lawyer, and I follow up with him. He forgot to think through the insurance, thought through thinking about the accounting piece.
Yep.
He's connecting third-party admin. There's just so many things that you have to do, which is kind of frustrating. Yeah. That your lawyer they're just good at paperwork, right? They don't understand the actual mechanics and where it all moves and how it works. Anyways, pretty interesting.
Yeah, we noticed that too because we've now done multiple PPMs, and for those of you who don't know, what is it? Private placement
memorandum. Yep.
Memorandum.
Yep.
And you know, they send the initial draft, like you said, like it's 98% the same on both, and then you'd have to look for the little details where it changed.
Yep.
And we're like, dude, this is like. These things are wrong. These things are wrong. Like,
and they're 200-page documents. These are thick.
My gosh, dude.
These are thick documents. Yeah.
Yeah, 200 pages. Like, my guy is like needling through them to make sure that just one part could screw you if it's wrong.
Yep.
So, yeah, dude, it's I don't know. They're intimidating, but I want to make them not intimidating after this podcast.
That's why we're here. Yeah,
exactly.
That's why we're here.
So, before we talk about all the different fund structures and why it's actually not as hard as, you know, I'm making it seem, I'm being a little dramatic. Tell us about how'd you get into funds, man? Like, where'd you come from?
Yeah, so I grew up in Salt Lake City, Utah. Interrupt me, by the way, during this whole story as much as you want. But I grew up in Salt Lake, average household. I super ambitious, like most people you hear on here. And anyways, got to college. I was like a chicken with my head cut off. I started 6 different businesses my first years of college. So I went after it.
Give me some examples.
So I started a Chinese tutoring company. We had 7. So I started LDS Mission. I spoke Chinese in Taiwan.
Chinese. Okay.
Yeah. So I came back home. I was like, we could teach kids for $30 an hour.
Okay.
Cool. I had 7 tutors. We're doing this. Margins were terrible. I was like, crap, screw that. We built websites for people.
Okay.
We charged like $1,000 to $3,000 a website. As a college kid, I was like, this is amazing. You know, I'm making big money.
Yeah.
Wholesale 2 houses actually.
Oh,
$5,000 a pop.
you went into MySpace.
Yeah, I did wholesaling on 2 houses, which was really fun. We did Forex trade. I mean, we did any YouTube business that I probably watched some of your videos. Like, oh, I could do this, you know?
Did you flip couches?
No, not that. Yeah.
Okay.
Yes, you started, right?
Yeah.
We did the couches. Yeah. We didn't do couches, but
All right.
Anyways, finally my dad grabs me and he goes, Bridger, you're kind of like a chicken with your head cut off. He goes, I want you to go meet with this mentor that can really help you out. And I said, oh, cool. I'll go meet with whoever. Right. I go set up this appointment. I'm driving to this guy's house. I pull up through this gated community and I'm like, man, this is a nice area. And I start pulling through this neighborhood and there's just huge homes and I start pulling around. And I pull up to this beautiful cul-de-sac and there's this gorgeous white home on the top that almost encompasses the cul-de-sac.
Right.
And I'm like, holy crap, like, who's my dad's business partner? Like, this guy's crazy. And we lived, I would call it a pretty average house in Salt Lake City. My dad drove a car with 300,000 miles on it. I mean, we had food on the table for sure, but no huge thing of wealth, right?
Right.
Anyways, I knock on this guy's door. I'm a little nervous. I feel like a butler's going to come and, you know, like, be gone, peasant, get out of here, right? Like, I didn't know, right? I'm a little nervous. Anyways, finally, my dad's partner comes to the door. Goes, Bridger, come on in. He brings me in. There's got the wine cellar and the basketball court in the basement, the car, the whole thing, right?
Right.
We sit down, we start to chat, and I finally ask him, how did you get all of this? Like, how'd you do this?
Yeah.
Like, tell me. And he goes, it's funny, not a lot of people ask me that question. I was like, oh, shoot, I don't know if you're not supposed to ask rich people that question, but like, that's the only question I have is like, how do I do this, right?
Yep.
And he goes, when I was in my 20s, I was a lot like you. I started a bunch of businesses and blah, blah, blah. But he goes, then I met one of the person who changed my life. I met this guy that ran a private equity fund. And he was one of the wealthiest people I'd ever met in my life. And he goes, I don't care how long it takes me.
Yeah.
I didn't care if it took me 1 year, 5 years, or 20 years. I was going to figure out what this fund world was, how to start one and how to scale one. And he goes, that's what we did.
Right.
And he goes, me and your dad and a couple other partners started a fund. And currently we manage just over $8 billion of real estate.
Wow.
And to put that in perspective, a lot of guys follow like Grant Cardone or Cardone
Right.
Capital, right? At the time, that's 4 times bigger than Cardone Capital is today.
Right.
And now they're over 10 times bigger than Cardone Capital. And they're doing multifamily, office, like the whole thing, right? And I was blown away, right? I was like, wow, this whole world of funds, the secret rich, this is what the rich people do. They want their kids to go work in hedge funds, private equity, family, and then come back home and run the family office, right?
Right.
So anyways, I was super intrigued. I was like, I want to learn about the funds, right? Like, what is this world? And I finally asked him, I've heard from shows like this, find a mentor. Everyone tells you, find a mentor. And I'm like, hey, will you be my mentor? I'd love to learn from you. Can you teach me? And he goes, Bridger, go talk to your dad.
Yeah.
Your dad knows way more about this than I do. And I said, no, my dad's kind of poor. I want to learn from you. Like, you're the guy. Like, look at you. And he goes, Bridger, sorry to break it to you, but me and your dad make about the same amount of money.
I was about to ask you that because you were like, yeah, he has a 300,000 mile car and this and that. And then you're like, business partners. I'm like, wait, why is your dad poor?
Yeah.
So what happened?
So that's, yeah. So my chin drops to the floor. I'm like, huh? Like, what? He's like, yeah, we're pretty much equal business partners in this thing. I left this dude's house. I drove straight to my dad's house. I was like, Dad, what the heck?
Yeah.
Like, what's going on? Like, why haven't I been able to order a soda at Chipotle for the past 10 years because it's too expensive? And yet you're running this, multi-billion-dollar fund. And anyways, long story short, he goes, yeah, I like to save and invest my money. My business partner likes to spend his money. But yeah, we run this fund and that's what we do. And so he actually started to sit down and teach me about funds. Every Sunday night I'd drive over to his house and we'd whiteboard out how funds worked and how they're put together and how to raise capital, the whole 9 yards.
His business partner was teaching you.
No, this is my dad.
Oh, okay.
My dad. Yeah.
All
So
right.
my dad started to teach me and mentor me through this whole thing. So
Okay.
I'm in college at the time. And there's a funny thing, this, when you start to learn about something, you start to see that thing in your life. And so I was in college. I'm working another job at the time. As you can tell, I'm not getting money from my parents, right? I'm still working. I'm doing my college thing. And at that job, I had an idea that we could start a fund inside of this company, that we could lend money to some of the clients that were coming through. They needed financing. We could give them a loan. And so I was like, this is a great idea. So I took this to my dad. He thought it was a cool idea. We started to put this together, this fund. I'm 22 years old at the time. I was really excited.
Yeah.
And we formed this whole thing. And I'm like, okay, I got this fund ready to go. I'm so excited. And I said, shoot, I've got to raise some money now. Like for whatever reason, I overlooked like the biggest thing of a fund is you need capital.
Yeah. People got to trust you.
Yeah. They got to put money. I was like, crap, what am I going to do? And I thought, oh, well, it's easy. My dad, right?
Yeah.
My dad's rich. He'd love to invest in this fund.
Yep.
He already likes it.
Yeah.
I'll go pitch my dad. So I remember it was a late Sunday night. I went over my dad's home office. I knocked on his little door. I was like, Dad, hey, can I come on in? I was going to pitch my dad, right? So I sat down with him, had the pitch deck all ready to go, and my best pitch voice possible. I go, Dad, how would you like to be our first investor in our funds? And just like that, I put my hand out too, the whole thing. And my dad kind of laughs and he goes, Bridger, he goes, I have the money to invest, but if I invest in your fund, this will be a crutch that you'll never be able to recover from.
Yep.
If your first investor is your hardest investor to find, and if I do this for you, it'll ruin you for the rest of your career.
Yep.
And he said no. And it was this big tough love moment between me and my dad, and I kind of walked out with my tail between my legs a little bit, and you know, a little tear, a little in my eye, and I went out and said, screw it, I'm gonna take him up on the challenge.
Yeah.
So I went out, I talked to everybody I knew, former bosses, college professors, friends, whoever it was. And after like 3 or 4 weeks, I raised a whopping $49,500, which though I was stoked about because it was enough to get started. We were it was a micro fund. We were doing these small loans. The loans were like $500 to $5,000 in that range. Okay. They were short-term loans. And so we could start. And I was stoked. We started our first little fund. I'm 22 years old. I'm more of a syndicate, I guess you could call it.
$50,000.
$50,000. And it was awesome. Our first group of investors, we got them a 64% return on their money, which was amazing. Small amount, but good return. We closed that fund. Then we were like, let's actually do this at scale. So we launched a second fund. That fund we ran for about 3.5, 4 years, something like that. We raised and deployed millions of dollars out of that fund. Did really well. I just sold that fund last March. Had a competitor come buy us out, which was awesome. And then right now we're launching a new fund, a crypto fund that we've raised a significant a ton of money for already. And anyways, we're launching that really soon. So it's been really fun.
No, that's crazy, dude.
That's how I got into it, though. That's how we got started. Yeah.
Yeah. So tell me, like you said, you sold the fund after a few years.
Yeah.
For us, like we're buying and selling real estate in our fund. And to me, it's like, okay, we wouldn't really sell our fund. We would just sell the real estate. Like, how do you sell a fund?
So selling a fund is unique. And most funds aren't sellable, I would say.
Yeah, that's
because you have assets in the fund, right?
Right.
Our fund was because we had notes. So we would generate new loans. It was a debt fund. We were generating loans. We'd do 30 to 100 loans a month.
Were they like hard money loans or like
these were short term? They were not backed by any collateral, backed by the credit. So we essentially pay off people's credit cards for them.
I got it. Okay.
For a short period, for 6 weeks or 8 weeks, and they pay us back.
Got it.
And so they were short term. We had this, and essentially we had a system of leads that would come in. We'd finance them over 6 weeks, and we have consistent cash flow. Versus like, hey, we have 5 big properties that we're taking down in our fund. So that's how we could sell it. Was we essentially sold the system.
Yours is more of a business.
Yeah, it's more of a business and backed by a fund that needed capital, right?
Right.
Which is actually cool. We have now, and you mentioned we do content, we have a show and all that kind of stuff. It's really cool to see the different types of funds. You typically think of traditional private equity, or which we can talk through the differences, a hedge fund, a real estate fund. But we have guys in our group doing funds that buy almond farms. We have guys that do solar farms. We have guys that buy scripts on Hollywood from broke writers for $20,000 and sell them to Netflix, HBO, Amazon for $100,000, $200,000, $300,000. That's a fund, right? We have guys that they have a business. I won't disclose the name of them, but they have a business. They want to buy up their 3 competitors.
Okay.
So they started a fund to go buy up their competitors. So there's a lot of different unique ways you can use pretty much any business that you have that just needs capital. A fund or syndication is usually a really good vehicle to fund and finance that business.
Okay. So I got so many questions.
And that gives you a ton of rabbit holes.
Yeah,
to go down.
yeah.
There you
I'm trying to think how I want to tackle this because there's a lot of different ones. But one thing you mentioned was if I wanted to buy up my competitors, right? I'm a competitive guy. One way I would think about doing that, let's just say, one of my companies, we want to go buy these competitors. And so one way would be to go public. You go public, you sell equity, and you use the money for whatever.
Raise much capital, yeah.
I could go and buy competitors with it. How would that differ than a fund? Like, what if I started a fund with one of my companies? Would I be giving up equity, or how's that?
Great question. So, the other model would be like the Shark Tank model. Hey, we're gonna give up 25% of our company to raise capital to go buy up competitors, right? Or we can raise debt. We can get an SBA loan, which is another great. You can do that too if you have good credit and you've been in business for a while. You can do that. What we've had people do through the fund route is they keep and control 100% of their company. So you don't give up any equity, which a lot of founders don't want to do, right?
Right.
You set up a separate fund, general partner, limited partnership, separate from your business.
Right.
You raise $10 million there. And the purpose of that fund is you can do whatever your bylaws tell you can do. So you could give a loan that you're going to go buy, or maybe loan or equity that you're going to go buy up your 3 competitors.
Right.
They're going to go into the fund, and you're going to do a profit sharing with the general partner. And after 3 or 4 years, you have an exit strategy. So once those businesses cash flow, you could even say, if you wanted to, you get to write the rules of your fund, which is awesome. So you could say, hey, all investors, once we get you back your principal plus 30% for every year you've been in, you're paid out completely.
Right.
That's actually a really cool way where you can, so after 5 or 6 years, the cash flow from those businesses pay off the initial principal and the investors, and now you move those investors out, and now you own your business still 100%, and now you control these 3 competitors as well.
Yeah.
You can do the same thing like refinancing out investors.
Yeah,
same
you're
model.
just taking out debt to go do something, and you're going to pay it back.
So it's cool though. You get to write the rules, so you can do whatever you want. We have a guy that raised capital for a huge energy deal he's doing out of the Western United States, hundreds of millions of dollar deal. So he didn't want to give up equity of his company. Set up essentially a side vehicle that would go and build this new facility, this new thing that he was doing, and that would be controlled by his new fund that he controlled.
Got it.
Yeah.
Okay, that makes sense to me. So tell me about the different funds then. You mentioned private equity. You mentioned hedge fund. I have a 506c, which we talked about. Most people listening have probably heard these terms, but to me, it's like even owning a fund, I'm like, I don't even know the difference. What are the differences?
Yeah, so we'll start simple.
Okay.
Let's just go simple to advanced. So when I mention the word fund or syndication, all I mean is a pool of capital. So a pool of money, investors put money in that pool. Us as fund managers can draw from that pool and go buy assets. Whenever those assets make money, they flow back to the pool, and we split them between our investors and ourselves.
Right. That's
the most general sense. This goes back to like the dark ages. I mean, we've been doing this for thousands of years.
Yep.
So the only differences between a hedge fund, private equity, venture capital, debt funds are what they buy. They're actually, so we do these and set these up. They're almost all set up identical. They're almost exactly the same. So the difference is, so we mentioned a real estate fund, same pool of money. The fund managers buy real estate. It's in the name. They go and buy and sell real estate. Whenever the real estate makes money, you split that between your investors and yourself. Private equity. Private equity is a pool of money. They go buy and sell private equity or private ownership of businesses. So a great example is Sycamore Partners. They're on Wall Street. Sycamore Partners owns Nine West Shoes, Aeropostale, Staples, and last year they were trying to buy Victoria's Secret.
Those are not public companies.
Those are all held by Sycamore Partners as private companies.
Wow, I didn't know.
Yeah.
I thought those were all public companies. That's crazy.
So, and they sometimes they'll have them private, take them public. They'll sometimes have them public and take them private. I mean, that's a big scale private equity fund. But we have guys that do small scale private equity, like buying up their competitors, or they're a restaurant that wants to buy up other locations, right? That would be, you're buying private companies. Hedge funds, same model. Instead of buying private, you're buying public. So you're buying stocks, you're buying bonds, equities, futures, options, Forex, crypto would all be under the hedge fund model. Debt funds, you're issuing debt. You're issuing mortgages or loans. Venture capital, you're investing into small startups. So again, they're all exactly the same, pretty much. There's nuances to each one, but they are all just a pool of capital, and that's what they're doing.
And they're just defining what it is their goal is.
Which is funny that that's why we started making content, by the way. No one teaches this. No one actually explains this online anywhere. So we were like, well, we might as well do this and start helping people understand this. And even for me, it was like, oh, once I put that together, I was like, that's really simple.
Yeah.
All these finance people on Wall Street try to make finance so complex. And you do a great job of this too. People make real estate so complex. And then you break it down and make it really simple, right, for people. And anyways, it's really funny. Once you get down to it's actually not that crazy. It's not that complex.
Well, now that I understand it's the same thing, it's just different names for kind of the niches that they're, putting that capital towards. It all makes sense. So, when we look at, I understand that part. You look at the 506C and the 506B. You want to explain the differences for everyone?
Yeah. So, in the fund world or fund law, there's actually more than those two as well, but those two are under, you're going to launch a fund. You now need to file for exemptions from certain things. And that's why a fund doesn't have to file like a public company or other things like that. So the most common ones are under Regulation D as in dog, and it's 506, Rule 506, and then there's a B and a C.
Yep.
And 506B, that little subcategory, is where 99% of all private money in the world is raised. I mean, I'm talking trillions of dollars go through that little Reg D 506B segment. Now, a 506B, B as in boy, there's a few nuances, and then we'll talk about a C in a second, which you run a C, and I'm launching a C as well. A 506B, you can raise unlimited amounts of money.
Yep.
You have 35 non-accredited investors, and you can have unlimited accredited investors, depending on your file type. Usually you'll be capped at either 100 though or 1999. Anyways, we can get into that nuance in a second. We won't talk about that now. One of the biggest things of a 506B is you cannot publicly advertise. This is the reason you don't see billboards for KKR, Blackstone, BlackRock. I mean, these huge Sequoia, you do not see any advertisements at all. It is against the law for these big firms to advertise.
Right.
Just by that, and we can talk through why it's that a law, but that's just the law. You cannot publicly advertise your fund as a 506B, which all these large funds do.
Right.
Now there's a subset, a 506C, which you mentioned. That fund, the only difference is you can advertise it, but you have to verify accredited investor status in that fund, which let's talk about that. So, inside of the fund world, you guys still follow along? Is this making sense? We good? All right.
Hey, if it's making sense, comment below. Let us know it's making sense.
So there's tiers of investors that the SEC put out. We have a lot of people have heard of the non-accredited investor and accredited investor. So an accredited investor is someone who has $1 million net worth, makes $200,000 a year with their spouse, or $200,000 a year by themselves, or $300,000 a year with a spouse. So easy way to remember is 1, 2, 3. That's an accredited investor. If you meet that definition, you can typically invest into a lot of things. There's a lot of securities laws around not allowing people to invest unless you're an accredited investor. And the reason for that is, in my opinion, the SEC is designed to protect the little guy. They hate slick talking fund managers like us that go and convince grandma to put in grandma's last $20,000.
Right.
And then we lose it. And now grandma can't survive anymore.
Right.
That was really the SEC was designed to protect the little guy.
Yeah.
If you take 20 grand from a multimillionaire and you lose it, well, tough, you know?
Yeah.
That guy or gal should be smart enough to...
They know what they invested in.
They know what they're doing, right?
Yep.
That's one of the reasons for the rule. So now there's 2 tiers above accredited investor, which a lot of people don't know about. The next tier above accredited investor is called a qualified client.
I didn't know that.
A qualified client has to have a $2.1 million net worth.
That's specific, but okay.
I know, it's really interesting. And above that is a qualified purchaser. Qualified purchaser needs a $5 million net worth.
Okay.
So on CNBC or wherever, Bloomberg, you'll hear these fund managers get up and they'll go, hey, we only take investments from qualified investors. You think they mean accredited investor above. They don't mean that. Right. They mean qualified client or qualified purchasers. Actually, there's different rules around them we can dive into if you want. A lot of big funds only take money from qualified purchasers there's certain regulations around that. We're going to launch a fund next year that we can only take money from qualified purchasers. You have to have a $5 million net worth to invest in our thing.
Why would you do that?
So the reason for that, and it depends on each fund category. So you have your 506B, 506C. Beneath that, we'll go one layer deeper. And then you choose after that which exemption you want. There's a 3C1, 3C5, 3C7 are the 3 main ones. And we can we're getting a little techno here, but we'll get into it.
Yeah.
3C1s, you're restricted to 99 investors.
Okay.
And most of the time, they're all accredited investors.
Okay.
A 3C5 fund is for real estate funds. I'm guessing you're a 3C5 fund. I don't know if you know.
I don't know.
3C5 funds are for real estate funds. Specifically, you have a bunch of it. As long as 80% of your holdings are in real estate, you can be a 3C5 fund. You get a lot of exemptions there. A lot of times you don't need a license to run that fund if it's under $150 million AUM.
Yep.
Anyways, the next one is a 3C7. Okay, a 3C7 fund, you can raise money from 1,999 investors.
Okay.
All of them have to be qualified purchasers to do that.
Oh.
Yeah. So our first fund that we're launching right now, we can only raise from 99 investors that are accredited or above.
Right.
But once we fill up 99 spots, we're filled up.
We need a new fund.
We need a new fund that has 1,999 spots. Everyone has to be a qualified purchaser, a QP fund. And we'll raise from 2,000 investors. Above 2,000 investors, you're seen as a public offering. This isn't a closed offering anymore. So this is the reason, to make this tangible, you see Ray Dalio or Ken Griffin that run these $100 billion funds. They only can raise from 2,000 investors. So Ray Dalio's minimum investment, to talk to Ray Dalio, you have to have a $5 billion net worth. Billion. Minimum investment is $100 million with their firm.
Wow.
They stopped raising capital in 2006.
Wow.
Ken Griffin, same thing. Jim Simons hasn't raised money in 11 years.
Wow.
Because he's filled up his 200 spots, or 2,000 spots, and those investors just keep dumping money back in. And it's just like, he's like, we're capped, right? This is all we can do. This is for hedge funds specifically. So anyways, that's the reason. That's why they get maxed out. and they only can raise from people. So that's actually, by the way, because you might be saying there's so much competition in the fund world. What happens is once a fund gets big enough, they actually move out of your competitive space as far as competing for investors. You aren't competing with Ray Dalio for investors.
No.
Because he can't even take those investors, which is kind of interesting. So it's like having, you have Facebook or Google or Apple, but there's a law that restricts them from selling to a certain category of individuals, which is kind of cool for emerging fund managers.
So is Ray Dalio managing just a private company still? That's what it sounds like, right?
So he manages Bridgewater Associates. They have funds underneath that.
Yeah.
Now he has multiple funds now. So they have multiple of these funds. Sorry, keep going.
Yeah. But they're under the 2,000 threshold. Mm-hmm. You were saying that once you go above that, now you're in public regulation.
Yeah. The way the SEC looks at it is they would say, this isn't a private offering anymore. You need to do something more public. So that's why, and that maybe you need to launch a public company or raise capital in a different way, which most of these fund managers don't want to do.
Right.
So they all just stop there.
So Bridgewater is not a public company, right?
I don't believe so.
But if he wanted to raise more, he'd basically be like, hey, Bridgewater's going public. You can invest.
So not exactly.
Okay.
Yeah. So now Blackstone did this. Blackstone was one of the first private equity groups to actually go public.
Okay.
So now it's interesting what they did. So Blackstone, same kind of model, 2,000 investors, they took their general partner, which is their just management companies, they took that company public. They didn't do the capital raising side public.
Right.
So you can actually go buy shares of Blackstone right now, which if you don't know, Blackstone is like the top private equity firm in the world. I mean, they own everything.
Right.
If you look it up, I mean, there's probably 20 buildings or companies in your state that are owned by Blackstone that you have no idea that are owned by Blackstone. Right. They own a lot of buildings on the Strip you would never know of. They own a lot of they're the backbone of a lot of these companies. So they took their management company public. So you can buy shares of their management company, but when they launch a new fund, you still can't buy into that fund.
Right.
And a crazy story about Blackstone, just while we're talking about them, they launched a new fund. I'm going to get the numbers wrong, but it was about a $10 billion fund.
Uh-huh.
Typically, a fund manager to raise even $1 billion, they usually raise it over 12 months, like a year. They go dog and pony show. They talk to institutions. You're bringing in money over about a year. And then after a year, you've raised $1 billion.
Right.
Blackstone has such a great record and name. They invited all their investors out to a big hotel in New York. The conference started at like 10 a.m. They pitched from 10 a.m. to 1. From 1 to 3, they had a breakout session. From 3 o'clock to 7 p.m., you could write subscriptions and subscribe to the fund and invest. And they closed the fund at 7 p.m. that night.
They raised $1 billion.
They raised I think it was around $10 billion in about 12 hours. That's insane.
Yeah.
Like you talk about like an NFT drop that like killed it. Like that's a drop that absolutely, that's how they raise all their funds. So that's once you get to that level, you're in that place, which is just insane.
Those guys are crazy.
Yeah.
We all know that I love creating passive income through rental properties. But did you know that you can create passive income through owning an e-commerce store? My company, Lunar Ecom, can build and manage a store for you on Amazon or Walmart. We'll handle everything from starting the store, picking the products, and all the day-to-day operations. It's completely passive for you. If you'd like to learn how store owners are making thousands a month in passive income, head over and watch the case study at lunarecom.com. It will explain everything you need to know about the industry and why I'm so excited about it. So to see the case study, head over to lunarecom.com. Most people want to get rich at all costs. They make sacrifices with their family, their health, and their faith, all in the pursuit of money without even realizing it. But what if I told you it doesn't have to be that way? What if you could grow your wealth in all areas of life? Well, it's possible, and that's why I created The Wealthy Way. It's a community of people striving to grow together in all areas. And we have multiple tools for you to use that are completely free. You can get access to the Wealthy Way Planner, where you can set goals and hold yourself accountable on a daily basis. We also have our Wealth Builder Academy, which is over 4 hours of content teaching you how to manage your time, create the right goals, and all the biggest secrets I've used to grow my life, not only in my net worth, but in all aspects. Lastly, we have our Discord community where thousands of wealth builders are all over the world encouraging one another and growing together. And once again, all of this is completely free. There are no upsells, there are no hidden catches. For me, this is a passion project and I want to build a community of like-minded people. So if you want to start living the wealthy way today, go to wealthyway.com. There you can get all the free resources like the course, planner, and Discord community. So go to wealthyway.com. So with, there's so many questions I have, but on that topic, okay, you talked about how these guys who are investing $10 billion, they're not just, normal people being like, hey, I'm a qualified, partner. I got a $5 million net worth. Like, are they raising money from other funds to do this? Like, how are they doing it?
Yeah, so they'll raise it from all over the place. A lot of sometimes other funds, but big institutions. This could be, and a lot of people don't know this, like insurance companies. The reason AIG collapsed in 2007, 2008, remember that? AIG got bailed out, and it's like, why is an insurance company a part of this? Insurance companies are one of the biggest investors on the planet.
I didn't know that.
Because you give your premiums to AIG,
right,
and they don't just sit on them. They go invest. And they invest in huge tranches. So, and a company like AIG has hundreds of billions of dollars that they deploy into funds like Blackstone and to KKR and all these big firms.
Because I don't want to just sit in there doing nothing.
Yep. Yeah. So you got huge, central banks can even play in this realm. And actually, not central banks. They can give liquidity to these funds, but huge institutions and large banks, large pension plans. So like the St. Louis fireman pension plan that has $200 billion in it.
That would only count as one of your investors, right?
Mm-hmm. Yeah.
Okay. So a qualified partner doesn't have to be a single person. It's an entity. It's whatever.
So yeah, it's interesting nuance. A lot of those big institutions, sometimes they'll have sidecar letters. They invest different ways. In your fund, if you're raising from a qualified purchaser from an entity, that entity has to have $25 million in assets or more to be an entity. And the primary purpose of that entity can't be just to invest in your fund. So you couldn't say, hey, I've got 300 friends over here. Yeah. We're going to group capital together and then give it to Ryan.
Right.
It's like the SEC smart. They understand that. They have what's called a look-through clause, and they look through to that entity. So that entity that's investing has to also invest into other business ventures and have other purposes beyond just investing into your fund. Does that make sense?
Yeah. Yeah. Crazy stuff.
Yeah, this is the world of high finance. This is like the huge, which is just cool that I'm kind of exposed to it, that I get to be around the people that are doing all this stuff, and I want to be in those conversations one day. But you have these, major mortgage pools being moved around and huge, institutions and sovereign wealth families. Yeah. That's the type of groups you're talking about that are investing into that.
So the big, Blackstone, a lot of people talk about them. But were they a part of BlackRock previously, or their executives? Like, isn't BlackRock the biggest?
Yeah, so BlackRock is interesting. Blackstone and BlackRock, I can't remember the whole story of the foundation, but they split off.
Right.
Their executives split off. BlackRock initially started as a private equity group, and they were going to do private equity similar to Blackstone. And then the Fed stepped in and said, let's partner with BlackRock, and they can be our asset purchaser, essentially. So BlackRock kind of has become the Fed. It's their arm and their way to control the world, essentially, is if you want to get devious about it. But
they have trillions of dollars in assets.
It's $6 trillion that they manage and oversee. BlackRock is insane, and it's Fed backed. It's the Fed's money that they use. They're essentially, Larry Fink is essentially,
they don't need to raise money.
No, they're an arm of the U.S. government, essentially. They are the U.S. government's arm that goes out and buys companies, equities. They bought, I think it was like 30,000 homes this last year. And single family homes.
Why would the government do that? Why would they need to go buy homes? I get buying companies for control and stuff, but like, why?
I don't know. I have no idea. I put a whole video out, like conspiracy of why they would do this.
Give me the top conspiracy. What is it?
Well, I think they see a huge,
to keep prices up.
It could be to inflate price. It could be to help spur on growth. And typically, you listen to Jerome Powell, they're trying to inject capital into the economy this last year.
This is one way to do it.
One way, let's just buy up homes. Let's give people liquidity. Let's inflate home prices in Texas and Florida, wherever they're buying at.
Yep.
That's one way to do it. You could go deeper if they want to control more land. They want to have, Bill Gates was the largest raw land owner in the United States right now. Over the last 2 years, he's been buying raw land like crazy. One of the biggest reasons for tax credits and carbon credits,
right?
That you get from that for all sorts of reasons. So I don't know why. That would be the ethical way, though. They want to provide liquidity to the markets, which is crazy, though. The Fed itself owns about 20,000 equities. Like equities meaning stocks. Like the Fed is buying. This is brand new.
They're adding liquidity into it already.
They are buying Google. They're buying Apple. They're buying Netflix.
They're pumping these stocks too.
Why is the Federal Reserve buying Google? Like,
do you think they just want to control Google because Google's too powerful?
I think they are trying to they were trying to inject liquidity into the market so much during COVID, right at the beginning of COVID.
Yeah.
And this is one way to inject capital, to inflate prices, to just because they can only do so much with bond buying and treasury buying. There's only so many buyers.
Right.
This is another way to do it, was buying houses, was buying all this stuff.
This is
now,
the first time they've ever done this.
I mean, they've done it in the past, but not to that scale.
Right.
I mean, this last movement from the Fed since COVID started has been insane. I think the Fed currently has about $8 trillion in their balance sheet. So to put that into perspective, 2007 happened. The Fed, and what it means to inject liquidity is if they buy a stock from you, they now own a stock. They gave you $500 for that stock. You have cash that you can now go use and buy stuff that would hopefully help the economy. That's what they're trying to do. They're buying a lot of assets. So in 2007, 2008, they went from, I believe it was 1 trillion to about 2 trillion.
Yeah.
And it was like big news, and it was okay. And they came on the news and said, hey, you know what? This is just temporary. We're going to shrink our balance sheet back down to about $1 trillion.
Uh-huh.
Today they're 8 trillion. Like that just never happened, right? They just kept going and going and going.
They couldn't help themselves.
And people are talking this year about, they're tightening interest rates, and they're quantitative tightening is what's going on right now. They're just being less loose. If you're quoting Peter Schiff, that's what he's talking. They're just being less loose. And I like Peter Schiff. I like some of his stuff. Some of it I don't like. But that's the truth. I mean, we have really loose monetary policy right now, which has pumped this economy like crazy. And everyone that we know essentially has made money on. Anyone that holds assets has made a ton of money the last 2 years, 3 years.
The rich are getting richer for sure.
The divide is huge, and they're trying to taper this back, hopefully in a controlled manner. I hope they can do this well, but we'll see. Anyways,
what's your guess on what's going to happen with interest rates this year?
I could see us happening. I think. Well, two thoughts. We've already had this huge overreaction in the markets to rate hikes,
right?
And they're signaling March 15th as their first rate hike. It sounds like they're going to do 4 to 5 rate hikes this year at 0.25% each. That's what they've signaled. I think my prediction, again, who knows if this is correct. I think they're going to do 1 or 2 of these, and the supply chain issues are going to be major, and the pullback from the economy and the asset prices are going to drop so much that they're going to stop. I think. The thing that's now people are talking about, is the U.S. dollar going away? Are we devalued as a world currency? The answer is, in my opinion, where are we going to go? We're not going to use the Russian. We're not going to go to rubles. We're not going to marks. We're not going to the euro. We're not going to yen. These currencies are all way worse than we are.
Right.
It's like we're the tallest midget at the circus. we're bad, but at least we're not as bad as everyone else, right?
Right.
And so then we can talk about digital currency as well. I think the Fed will have a Fed coin here pretty soon.
Yeah.
Anyway, we can talk about that if you want, but I think I could see us having 3 I think they're planning on doing 5. The conversation that I've heard is 5 rate hikes. I think they're going to hit a couple of them and feel the pressure and stop.
Yeah.
Or anyways, what do you think?
I've said this before they even announced. I said they're going to announce it. They're going to do it, and they're going to see the negative effects, and then they're going to stop, and then I think they're going to lower again. I think they're going to save face and just say, you know what, we tried. The economy's too weak. We got to keep lowering. And I had Grant Cardone on the podcast a few months ago, and he made the bet. He said, I bet you, I think this was in November. He's like, I bet you rates are lower a year from now than they are today. So, I mean, Cardone's a pretty connected guy, and for him to have that belief that they're going to be lower too is like, we'll see.
Yeah, I mean, the responsible thing to do is for them to raise rates, but I mean, is it worth putting us into a recession with? I mean, and then you see the political aspect of it. You have midterms this year. I think that's going to be a huge poll, and Democrats are on the polls right now getting just destroyed in midterms, at least so far. I could see, if there's a recession that happens too. I mean, that doesn't play well politically for Biden and that. So I could see them pulling back, like you're saying, on those rate hikes.
And that was one of my things was, nobody wants to be responsible for the next crash. So
yeah,
they're going to keep kicking the bucket.
The other crazy part, though, is back to the shortest, the tallest midget at the circus. There are around $18 trillion of 0 or negative interest rates or bonds around the world right now. Negative rates.
Wow.
Which is just insane. A lot of people don't realize this. You go look it up. It's absolutely insane. And it's not like a little amount. I'm talking $18 trillion that are at 0 or negative rates. So the way that works, so my dad, we have a friend that's in Denmark, and he has an adjustable rate mortgage on his house. The mortgage went negative. His mortgage company pays him like $23 a month to have a house.
Why?
Isn't that crazy? The other way to look at it is a negative rate. So I'm going to put my money into a bank at a negative rate. I'm essentially paying a fee for them to protect my money every year. So if I put $100,000 a year, I'm going to give them $1,000, 1% negative, so that they just hold and protect my money.
Right.
Which is just interesting, right? And you look at these asset
they're
managers.
They're going to get robbed or what? Like,
so the people are looking for yield at a large scale, and they can't find it. So there's these another kind of family friend of ours, a large asset manager in Europe. And just this is theoretical, but every Friday he gets a huge pile of cash on his desk from these pension plans. So he's got all these pension plans that every Friday a paycheck hits, and he gets the cash from that, and he is supposed to deploy that cash into, his charter says, U.S. bonds and treasuries. Not U.S. government bonds and treasuries. Every Friday, and he gets this cash. Now, the rates went negative last year on him.
right.
So he stopped buying. He's like, well, I might as well just hold the cash, then hag negative. He got a call from the people that set up the pension and said, what are you doing? Why are you sitting on so much cash? He said, well, there's nowhere to put the money, right? It's all negative. Then they said, you will be displaced as an asset manager unless you deploy this capital like you're supposed to at a negative rate or whatever rate it is into treasuries and bonds. So he said, okay. So he was buying negative bonds and treasuries in Europe.
He was just forced into it.
He was forced to do it, which is because of his charter, right? Mm-hmm. And the way their pension was set up. Just so interesting. So then you have the whole, and now inflation has hit this year. And so people have to hold assets. And now you have asset inflation, right? So everyone's holding on to equities that have no value of a price earnings ratio. Real estate's, everything's inflated.
Right.
But it's like, well, what else, right? Same with the US dollar.
Right.
It's like, well, what else is the great question.
Yeah. Crazy times.
I know, it's interesting.
It's crazy times. So, you had mentioned the U.S. doing a digital coin at some point, Fed coin or whatever. And I've gotten heavily into NFTs and crypto in that space. Now, you're seeing a lot of people start to go into crypto for various reasons, right? You get a lot of people who are just looking for a moonshot. They're trying to, go hit 100x. Yep. You've got guys who are doing stable coins, like they're just staking their money to stable coins. They're making 10, 20%, and they don't have to worry about just like price, like the volatility of normal crypto.
Yep.
And then you got guys like myself who are going the NFT Metaverse route and looking at all the possibilities of, tokenizing different things we can do. So my question is, you're starting a crypto fund. Okay. Like, what's the purpose of this?
Of starting the crypto fund?
Yeah.
We have a ton of people in my network and my partners network that are begging us to get them into crypto. A lot of these old dogs, people, and they're like, please get me. And they some of them own Bitcoin, but they want to get into new projects and be diversified well. And our thesis of our fund is to mitigate downside risk like crazy, but also have the upside. So we get a lot of, new coin drops. We do the research and we can compound and stake very well. We have a whole portfolio strategy, which we can talk about more if you want. But that's the biggest thing is we've had people just begging us to take their money to get into this space. And then secondly, to get into it securely we're spending now 6 figures a year in security and multi-signature wallets and ways to set up to make sure that we're not hacked. Because a lot of people are really scared of, like you saw this morning, Bored Apes were getting just stolen off of Coinbase. You see this morning?
No, I didn't.
So there's a huge hack on Coinbase. There's a piece of code apparently. If you had your Bored Ape on Coinbase or listed, they could hack in and change. If you were trying to sell it for 200 ETH, they could go change it to 20 ETH or 2 ETH. And buy it and then move it out. And all these people this morning woke up and their Bored Apes were gone.
Dang.
So there's this huge thing. And anyways,
Coinbase going to have to reimburse them.
Yeah. So they on OpenSea. Yeah. So the people that were on OpenSea, anyways, if you're doing that right now, just move them off to a secure wallet. Sever the tunnels, by the way, between those wallets. So I have a good friend. He lost a couple $100,000. And this is interesting. I didn't know this before. If you connect like your MetaMask to your Coinbase, your crypto.com or whatever, and you transfer that way, every time you can make that connection, it creates a tunnel between those wallets. There was a coin called the Squid Game coin. That coin was a total fraud, rug pull, and anyone, I don't know if anyone, but some of the people that were connected with the wallet, they could reach through their wallets through tunnels and grab whatever assets were in. So if you had your MetaMask to your Coinbase, they could reach your MetaMask to your Coinbase and grab all the money out of your Coinbase.
Wow.
Isn't that crazy?
That is crazy.
And so
they're just, because it used to just be, if you gave someone your seed, that's how you get screwed.
Yeah.
Or, if you connect your wallet to some fraudulent site, they can go drain your wallet. But it's never been, they can go multiple ways.
So the security for that is sever those tunnels.
How do you do that?
So there's, I think it's called dbank, dbank.io or dbank.com. I can't remember the one. But you go there, dbank, and you can actually, it'll show you first off all the tunnels that are created on your wallets. And then you can go through and it'll help you detach all of them. So a really easy way to do it. But just make a transfer, detach it, and then you're good.
Wow, that's crazy.
At least not it's one way to, you're not good forever, but that's one way to keep security. So
that's crazy.
So I don't even know what you asked me. I got on a tangent. What was it?
Well, you told us about kind of what your fund's doing.
Oh, our crypto fund.
You're spending a lot on security.
Yep.
Speaking of the other type of security, the securities aspect of it.
Yep.
I've been looking and talking with my securities lawyer about how we can tokenize real estate, right? Like if I want to go buy this building that I'm in right now, how do I make this building into an NFT that I can then go sell to, other people? And it's funny because it is for sure the definition of a security. Like it's a fund. And I'm seeing everyone do things like this in real estate and other, like, in fact, I just, I bought into this thing called Links DAO. And basically all these people bought an NFT to be a part of this, and they're going to go buy a golf course with all the money raised. And because it's a DAO, we all have voting rights to pick which course we want to go buy. And to me, I'm like, as a golf guy, I'm like, this is tight. Like, I'm with it. I'm not there to sell it. Like, I'm like, dude, I want to, like, this is the first of its kind with buying a golf course. But I'm like, they definitely did not get security lawyer. They didn't, like, this is a fund to go buy a golf course. And yet anyone can go buy it. And they definitely aren't doing a 506B, non-accredited investor fund. Like, anybody's buying and trading these things. And I'm just like, what is going to happen to all these people?
Yeah, it's a great question. The ones I've looked at, by the way, you actually read the white paper. You don't own any part of what's going on at the golf course or whatever they're buying or whatever asset is back. At least the ones that I've read into. Now, maybe yours is different, but the ones I've seen, they are selling it. Hey, you got to buy a little piece of paper, an NFT. It's a little picture.
Yep.
And they pitch it, though, as, hey, we're also going to be buying, at least on the white paper, hey, our company also buys golf courses. But there's no connection between the two. That's how the white paper actually reads.
Right.
That's how, if they're smart, that's what I've seen people, securities lawyers do to separate it of, hey, you're just buying an NFT.
Yeah.
And yeah, we have this cool marketing thing. We do golf courses and real estate and stuff, but you're not actually tied to the asset at all, even though we're pitching it like you are tied to the asset. So that's the problem too, is you are, and we just talked about
even though the paperwork says you're not, everything they do publicly says you are.
You're buying into a golf course. Like, at least the papers that I've read, nothing is backed. Even the ones that are big, that are backed by gold or backed by gold mines or real estate or whatever.
Bitcoin mines.
I know, yeah. You're not actually backed by that at all. Or if it's backed to a really small amount that's negligible, and so that's how they write it off as a security. The other side, though, if they actually are tying it together, it totally, in my opinion, is a security. The SEC is just slow to get around to it.
Right.
I think they're going to have a lot of litigation in the future between all these projects and stuff. And they're going to have to, there's just so many of them though. I don't even know how the SEC is going to keep up. And now this is the last thing.
And by the way, a bunch of, like, 99% of these are not going to do what they say they're going to do.
Yeah, exactly.
Like,
and they can, according to their white paper.
I hope that we buy a golf course, but I'm fully prepared that, we're not buying a golf course. That's
a great way to say it.
And if it happens, whatever. But I'm an accredited investor, right? So it's like, I get it. Well, actually, I'm a qualified partner now that I know what that is. I didn't know that was a thing.
Qualified purchaser.
Yep. But, if I lose, I lose. Like, I get it.
Yep.
I'm the dummy who thought this was cool.
So the thing with the SEC, they've got so much. People always ask me, like, is the SEC going to come after me or whatever? The SEC has so many people to look out for and things to do.
Yeah.
They really only go after people once they get a complaint.
Right.
So if everyone's making money, the SEC, like, everyone's cool. Like, there's no big deal. The SEC comes and investigates when 2 or 3 or 10 or 20 people call in or send a letter and go,
you got a rug pull.
Yeah, this guy screwed me, blah, blah, blah. And then they'll go, oh, okay, let's go look. Let's obviously go research that. So a lot of these groups, as long as the people make money, and this is again, the law according to Bridger, they won't get caught and once the official laws come out, they can then register and file and things like that. But we'll see. We'll see what happens.
Because I talked to my lawyers and they're like, yeah, you can do X, Y, Z. Here's how we would do it. Very similar to your crypto fund. It's just like, we're going to tokenize buying real estate and all that. So, and a lot of people ask me, they're like, what's the point of doing that versus a normal fund? And we were kind of talking pre-show that, like, for me, one of the biggest things that NFTs are going to do for real estate is probably inflate values, because now it used to be if you want to invest in my fund or whatever else, like, hey, it's a 3 to 5 year fund, because it takes time to get this thing stabilized. It's not going to happen overnight. And, your money's stuck there. Like, that going into it. But if you had an NFT that you could go trade between, you and somebody else, and that NFT has gained value because, we're managing it, it's appreciated, it's done these things. Well, now your money is more liquid. And so now you can start trading in and out of,
projects, properties,
that you wouldn't have been able to do with this current model.
It turns real estate into like almost a stock market.
Yeah.
Where you can buy and sell, you can day trade real estate.
Yep.
All of a sudden, right? Which is interesting
in
itself.
And it's the same thing we do with sellers on the house flips, right? Like, a seller needs to sell their house right away, right? So we get it for a good deal. That's what we've always done. And so you may get somebody who's invested in my fund who just needs liquidity right now. They've got the opportunity of a lifetime, or they got a problem, something happened in their business. They're like, dude, I need my money back. And so now having this option for somebody to come in, whether they overpay or get a good deal, whatever, at least they have an option to get liquidity.
Yep.
So I think it's pretty cool.
I know it's interesting.
But I would never do it until, like, the securities, like, my lawyer says, yeah, we can do it this way. These other guys, man, I'm like,
yeah, I'm a little worried about them too.
Yeah.
And the thing is, they obviously can raise money.
Yeah.
Big money, or, I just call it big money, is not moving out of space right now. And that's actually one of that. We talked about this before pre-show. I'm pro regulation around NFT, crypto, the whole blockchain space.
Right.
Because when you get regulators in, it then goes to these big pension plans. Oh, okay. It's finally regulated. Let's move. Because the whole crypto market is like, what, $1.5 trillion, something like right now?
Yeah.
After this huge sell-off. That's less than like half of Apple. That's less than Amazon, less than Microsoft. Like, it's so small right now, and you hear about it every day. It is so small, the actual capital that's in the market right now,
and it's going to explode at some point.
That's what it's just math. It's like, this is that's how I think about it, at least. This is the best technology that I've seen since, and I wasn't really, the internet came around kind of when I was young, so I didn't really see it. But blockchain is an incredible technology. And it's inevitable. That's what everyone keeps saying. I believe it. It's inevitable.
Yeah, I believe it too.
So
I'm with you, man.
That's where we're at. I want to ask you a question.
All right.
Metaverse real estate.
Yeah.
My biggest problem with it is, what if somebody just creates another metaverse tomorrow?
Yeah.
Because, like, these metaverses that you look at, the graphics are terrible. They're not fun to be in.
Right.
If I buy land in Decentraland,
yep,
what's stopping from tomorrow a new one that comes out that's hotter, and everyone sells out of Decentraland and moves to this new cooler one? It's cooler, and then finally, Yeah. I do believe there's going to be consolidation down to 1 or 2 main metaverses.
Right.
How do I pick the right one in that space?
I think my NFT is going to solve a lot of that with what we're doing. But to answer the broader question of, metaverses being unlimited, it is true. But I've said this before, like, the world, when you think about how much land we actually use in the world, it's pretty unlimited. Like, how much do humans populate of, like, the world, the percentage? I don't know, maybe 10, 20%. The rest is just like forest and desert and crap that no one wants.
Yeah.
And so, when you think about that, the reason that certain places like Vegas or New York or LA have value is because that's just where proximity is to people that deem it valuable. And so I think that no matter how many metaverses get started, 99% will be like nothing, right? You can take your moonshots on them and, maybe they develop into something. But, I think there's going to be the established ones that, reign for a while, like the Decentralands and the Sandboxes. They've established themselves. Like, I don't think they're going anywhere.
Yeah.
I think they're going to continue to get better. And there will be brand new ones, which are a great opportunity for us as investors to get in on the ground level. Like, if this new land is coming out that you're getting access to before anyone else, and that other big players are going to be involved in this from the beginning, that's a huge opportunity. So I like the aspect of new ones coming out. But what I think the misconception people have is that people are just going to go run around and hang out. And this is where Decentraland and Sandbox are going to have to figure it out, is that for people to go there in VR or PC or whatever, there has to be some kind of reason to go. You know, when you think about why humans go to places, okay, there's always a purpose. You know, they're going to go do something fun. They're going to go learn something at an event, right? So, like, I think that with most metaverses, they are going to be game related. There's going to be some type of game. You go there to go have fun. People have done it forever with Call of Duty and Fortnite. Those are metaverses. Like, you go to hang out there, have fun, play a game, you're chilling with your friends, and that's it. But the difference is in those games, you could never make money. You could never own land. You could never, you know, you build up your character in some of these things, but that's it. It's done. But you can't go sell your character. You can't go, you know, be rewarded for all the stuff you've put into it. So I think there's a huge gaming element.
So you're bullish on the gaming side of it, which I am too. I think gaming is for Metaverse, that is the play, at least the initial play.
Gaming's the play. I've seen these guys do like the Sims essentially. And I guess the Sims is a game, the way that they do it. But like thinking that people are just going to, you know, I remember seeing Zuckerberg's thing about like people are going to work together in the metaverse. I think that's like super far away. I think that's more of a VR thing where it's like, yeah, dude, this feels like real life. Like we're all across the world, but we get to go work together in this metaverse office. That's so far away. But yeah, I just think like you mentioned, like it's so early on that if you can identify the right things early on, oh my gosh.
Have you heard of Cinder.io?
Cinder, no.
Cinder, they are a game. So back to your point of hanging out, the game, you can go build a castle and have these cool unicorn stuff, but you build whatever you want. You can buy a big castle or whatever. You then form guilds, and your guild can go to war with other guilds. And you can go to war individually or whatever. But when you go to war, you can stake and put things out as a bounty. So if you go to war with all these dudes out of Europe, and you beat them, you take all their real valuable, like, you know, Bored Apes or their unicorn that was $1,000 or whatever. You grab all that into your guild. Which is it's essentially it's gaming. It's like World of Warcraft, but now it's like gambling mixed in, essentially.
Gambling
it's pretty crazy.
Gambling is going to be so big it already is in crypto.
You see Zedrun. Zedrun is totally just gambling.
Gambling.
It's horse race gambling, which is, anyways, whatever you want it to be.
Yeah, gambling's going to be huge. But the point is, unlike real gambling where, well, I guess they're both real, but like people work and do all this stuff at their job and they lose their money gambling. You know, a lot of these games, they're going to have this money that is essentially just like given to them as play money, just like in normal games, right? Like it's play money, but this new play money actually has value. Like when we play Monopoly, we're like, it's play money. But like imagine if you were getting real money playing Monopoly. That's where this is going. It's crazy, dude.
I know. Even outside of the metaverse, I'm super bullish on esports. Esports is one of the fastest growing things on planet Earth right now. I had a guy on my show that he was an esports expert and he's a part of FaZe Clan. He's the owner of FaZe Clan, which had a $1 billion evaluation. They're building like 33 stadiums around the country right now.
Who's that? FaZe Banks? Is that who it is?
The guy I had on my show was David Chun.
Okay.
So just crazy. I am a big believer in esports just because it's so many people are watching esports, the attention and you know about viewership. It's all about eyeballs. They are grabbing so many eyeballs right now. It's insane.
Yeah. Crazy, dude. Well, man, it's been good having you on. We didn't really talk much about it, but you know, for everyone listening and watching, Bridger has courses and coaching programs on how to start a fund. Obviously, the guy knows what he's talking about with funds. And if you want to learn how you can start a fund for any of these various things we talked about, crypto, real estate, freaking buying businesses, buying your competitors, you know, hit him up. We'll link to his stuff down below in the description.
We have a free course on funds for you guys if you want them.
Oh, perfect.
We have 30 plus videos. It's a whole free course on how to start a fund, how to scale one, the whole thing.
Okay.
So
perfect. So we'll link to that in the description and we'll link to his socials. He's got a great YouTube channel and making good content, man. So appreciate you coming on, dude.
Thank you, Ryan.
Yeah. So we'll catch you guys later, guys. Peace. Thanks for watching the Ryan Pineda Show. If you want to work with me, head over to ryanpineda.com. You can find my courses, coaching programs, and upcoming events. We also have free resources you can download, so head over to ryanpineda.com.